Hello everyone, in today's video I want to talk about the basics of the covered call strategy. I also want to talk about the options chain, like how do you even do that in Canadian brokerage accounts, because there's a lot of this information on the US accounts, but I really want to focus on Canadian accounts to help you guys all out. And I also want to share how you could collect this money tax-free. Hello everyone, just in case you don't know me, my name is Tracy. I'm a former engineer, now turned full-time investor in Canada. I've been investing in stocks and real estate for past 15 years while having a family, having a career, working for the government, becoming an independent consultant. And I just love creating multiple streams of income because, who doesn't love doing that and creating income even while you're sleeping? Now, if you want to hear more about creating multiple streams of income in stocks, in real estate, building your wealth and designing your best life even while you're in a busy profession, demanding career, raising a young family, all that, you definitely want to subscribe to my channel because I've done all that. Anyways, let's get back to the video. Now, I want to create this video because, well, the markets are crazy. It's bearish right now. There's so much volatility. And I thought, hey, I think everyone should at least know about this covered call strategy. Now, whether you actually use it, that's up to you, obviously. But I thought just sharing this is going to be so helpful for you in case you want to create a synthetic dividend off of your accounts. If you have 100 shares of certain stocks, you may want to create a dividend even if they don't issue a dividend, or you want to hedge your portfolio because you know what? A lot of our accounts are in the red and you still want to make a little bit extra money. Well, you could do that with the covered call strategies. Now, I wish I knew about this strategy many moons ago because I could have made thousands of dollars just knowing this strategy, which is why I'm so excited to share with you the covered call strategy. Now, this is the most conservative option strategy that I think is very powerful, and it works in all accounts in Canada. Now, the covered call strategy is a very popular option strategy used by investors to generate income thinking that their stocks are not going to hit a certain price, because either it's a bear market, so in the short term, you don't think the stock prices are going to go up any further, or you're in a super hyped up market where your stocks have jumped up and you don't think it's going to rise that much further in the short term. So what is a covered call? As a stock owner who owns at least 100 shares of an underlying stock like the Apples, Microsoft, Teslas, etc., you have the right to rent out your stocks and potentially sell them if it hits a certain price. And in exchange to sell this contract, you get to collect some premium while you wait. Now, the thing about these contracts is you got to put in an end date, which is called the expiration date. Now, I don't want to get you all confused with the financial jargon, but the underlying principle is that you're selling a contract to another buyer, and in exchange, you get a little bit of moolah. A great way to explain this is just imagine the housing prices were all traded on the stock market, and you can see your home prices fluctuate every single day, but you know that the average range in prices for your home is around $800,000 to $900,000 in 2022. Now, you know it fluctuates every single month, but generally it's between $800,000 to $900,000. And you're like, hey, I'm willing to sell my home if it hits $1.2 million over the next 60 days. Okay, so in the meantime, if someone's going to be willing to give you a bit of moolah to put that contract out, which is to sell your home at $1.2 million over the next 60 days, then you're happy to do that because you know that the probability of that actually happening is probably very low, like probably less than like 5%. Well, that's the same with stocks. Okay, if you own a bunch of stocks, bundles of 100, you could actually sell contracts against your stock and collect some moolah. Now, the goal is actually to choose a price you don't think it will actually get to by a certain date. Now, in terms of terminology 101, using the example of selling your home for $1.2 million, the $1.2 million is called the strike price. And you're saying, hey, I'm willing to sell this contract out in the market to sell my home for $1.2 million. And this contract expires by June 30th, 2022. So June 30th, 2022 is called your expiration date. So that's really all you need to know if you were to do this in the options market. So why would you sell a covered call? Well, because the markets are going crazy. You really want to hedge your portfolio and, well, at least make some money even while it's a bear market, okay? Because some of your stocks may not actually collect dividends in the true sense. So you create a synthetic dividend. Or you're like, hey, it's like hedging your portfolio because you don't think some of your stocks are going to do that great over the next couple months. Well, you might want to sell covered calls and again collect some income along the way. So what accounts work with the covered call strategy in Canada? We're so lucky in Canada that this actually works in any account. So you can do this with your LRSP, you could do this in your RESP, you could do this in your TFSA, you could do this with your corporate accounts, you could do this with your cash accounts, basically any account. And in order to collect the money tax-free, well, you just need to do that in your registered accounts, being your tax-free savings account, your registered retirement savings plan, or your registered education savings plan. As long as they're registered accounts, you could sell covered calls, collect the premiums, and collect this tax-free as long as the money is collected in your registered accounts. Now, of course, it's a different situation if you actually start withdrawing your money from your RESP or you start withdrawing the money from your RRSP outside of registered accounts. But if you collect this type of premium inside the account, you can collect it tax-free. Now, before I jump into the tactics of how to even do this in a registered account in Canada, I just want to share the number one reason why you wouldn't sell covered calls against your stocks. So the number one reason you wouldn't sell covered calls against your stocks is because you're so optimistic about the performance of your companies. If you are going to be super anxious about leaving money on the table because your shares could be called away on your favorite stocks like the Teslas, the Googles of the world, then you definitely don't want to do the covered call strategy. I know I said this is one of the most conservative, risk-free type strategies you could do, but I also want to share like the biggest downside. Sometimes you could be super anxious selling a covered call against 100 shares of your Tesla stocks because you know that potentially you could lose your 100 shares of Tesla, okay, which could be like really, really, really painful because you know in the long term it could be 3x to 5x in 5 to 10 years, right? So you're really potentially giving up a lot of upside. But at the same time, if you're like, hey, I'm cool with getting my shares called away because maybe at a later point I can buy back those shares, then that's the way to think of it, that maybe you're okay to sell your shares, your 100 shares of these stocks, okay? And maybe you're willing to buy back later on. But I just want to warn you again, if you do not want to sell your stocks, 100 shares of them, then don't do the covered call strategy. Because it could give you massive anxiety at night. And if you can't sleep well at night, then just don't do it. Now, in order to do this, you must be able to open an options account, okay? You could do this in Royal Bank, Scotiabank. You could use discounted brokerages like Interactive Broker or Questrade, where the commissions are a little bit lower. In fact, Interactive Broker has, I think, the lowest commissions in all of Canada. But say you're just with a regular bank, you could do this with Royal Bank. So you go to your Royal Bank, you have to sign up some forms that gives you options trading rights. So you got to fill out the paperwork that gives you level 1 options trading rights, okay? Just as a warning, if you go through the traditional bank route, like through Royal Bank or Scotia or TD Bank, this process could be very, very long, okay? They are super, super heavy on the paperwork. And it's not as easy as just doing this with Questrade or Interactive Broker. So if you want to go through a discounted brokerage like Questrade, well, you could get up to $50 commission free as long as you use my links below. Check out the links below. Plus, these discount brokerages, commissions are much, much lower. So when you want to sell, say, a contract against your Apple shares because you think Apple might hit some supply chain issues over the next month or two, that their next earnings report is not going to be that great, then you might want to sell a covered call, meaning one contract. And what you do is you go to the options chain, which is like financial jargon just to say the different types of contracts that are available, and they're called an options chain. Then you choose the price that you're willing to sell Apple at in a bundle of 100 shares at by what price, which is the strike price, and by what date. Now, the best way I can explain this is probably using an example that I did. So recently I sold a cover call against my Apple shares. Now, I love Apple. I've owned Apple for many, many different years. But at the same time, I want to hedge my portfolio. I also just thinking very, very practically, over the next 2 months, it's going to be a super bumpy ride. We all know about the supply chain issues. We know that Shanghai and parts of China have been shut down. And, Apple makes a lot of the products, obviously, in China. So I'm bearish in the short term. So I choose a price that I think Apple will not get to. So I think Apple will not get back to all-time highs, a little bit more than all-time highs, which is at a price of $185 per share over the next little while. So I go to my options chain, which is basically just a chain of all the different contracts that I can choose. I choose my strike price, which is basically the price that I'm willing to sell it at, or the price I don't think Apple will ever get to in the very short term. So I chose $185. I also chose the expiration date. So I choose the strike price, which is $185, and then I choose the expiration date, which I don't think Apple would get to by this date. And then I put in an order, which is called sell to open. Now, again, remember, options terminology is super confusing, but in reality, it's so simple. It's just this stupid financial jargon that makes it super confusing. But basically, you have to put sell to open one contract, choose your strike price, which is $185, and then how much money are you willing to accept for putting this contract out. Now, you got to choose a price between the bid and ask. The bid and ask is the type of insurance, the premium that you're going to collect. Now, you can choose obviously different strike prices, and then the premiums would change. So you got to choose the amount of money that you're willing to let go of your shares, that you think is worth the risk of having your shares called away, or you're just like, you don't think it will ever get to. So I chose the average between the bid and ask, and this is the amount of money I get back. So for me, I have obviously more than one contract, so I'm willing to sell 2 contracts against my Apple shares. In the meantime, I'm collecting a bunch of moolah. So what you do is you sell to open one contract, choose the strike price, choose the expiration date, and then collect the moolah. So you collect the premiums in your account right away. And then you wait. Okay, so when it gets closer to the date when your contract expires, you can actually close the contract if you want. You could always buy back your contract, which will cost you a tiny bit of money. Or if you're like, oh my gosh, you think that Apple shares are going to skyrocket to $200 a share because all of a sudden the markets turn around, then you could always buy back the contract. But unfortunately, when you do that, if all of a sudden the market turns back around to a bull market, then it's going to cost you a lot more than the money you collected to actually buy back your contract. So this is why I'm saying you must be okay to let your shares get called away. So once you put that contract out in the market, then you wait, and then you wait until the expiration date, and you, well, hope that it doesn't get to $185 per share like I have for my Apple shares. Now, if again, please don't do this if this is going to give you lots of anxiety of having your shares called away. In my case, I'm managing my risks. I own Apple shares in many different accounts, and this might be a way for me to just get my shares called away, and then I collect the money, and then I can deploy that capital somewhere else. But for you, you might get super anxious and nervous if you're going to sell a contract to get your shares called away, then you definitely don't want to do this. Hey everyone, if you want to learn more about like what strike prices to choose for your cover call strategy against your stocks, what are the pros and cons, when is the optimal time to use these strategies and all that, I could create another video like part 2 to cover all that in a Canadian markets. Okay, so please let me know in the comments below. Let me know, what do you want to learn more about the cover call strategy, or you just want to learn more? Let me know in the comments below.